Welcome to the Seattle Real Estate with Urban Ash, your go-to podcast for all things Seattle and Seattle real estate. Whether you're a first-time homebuyer, an experienced investor, downtown resident, or simply just curious about the latest market trends, we've got you covered. I'm Urban Ash, a 20-plus year downtown resident and real estate professional. Together, we'll uncover insider tips, share expert insights to help you navigate the market, and showcase community leaders and organizations. So join me as we dive into everything from the rental and sales market to the rich community life that makes Seattle so unique. Well, let's get started here then. Thank you, Carese, for joining. I always love checking in with you because you have such a pulse on what's going on in your world, and it collides with our world. And there's a lot of trends, and I always end up learning so much from you. And I do actually think that you, whenever we have new buyers or people with complicated scenarios, I mean, I hands down refer them to you because I always know that you're going to go ahead and go through everything with them, and everyone loves you. So
thank you. Well, likewise, the feeling is mutual. Always love working with you and your team. And you always have the pulse on what is going on the market too. So it's great to be able to collaborate.
Totally. Good. Well, I think the purpose, we have a couple different topics that we're going to discuss today. And I know you've prepared kind of some slides based on that. Obviously more of a kind of discussion of different things that pop up, but what's going on in your world?
Oh my gosh, just, a fun year. Every year, I feel like in January, we get a pulse for what the theme is going to be for the year. And I think the theme for this year seems to be slow and more of the same. I think people are they're just kind of waiting to see. That's the pulse that I have kind of deduced over the last month. I mean, that's just January, but that's my feel, is people are just kind of waiting to see what's happening. And I really don't see a year that's filled with that much excitement. I think we're not going to see a lot of change. It's going to be kind of steady, but rates over the year will trend down. I don't see inflation reigniting. So that's a good thing. I don't think people have to worry about that, but I don't think rates are going to drop quickly by any stretch. In fact, probably now is a good time to put up that graph I've got. And this might be able to kind of help people look at what I'm talking about here. So this is Fannie Mae's prediction. And of all the different companies out there that have tried to predict things, Fannie has been the one that's been the most accurate. Fannie's been pretty on. Redfin's been relatively close too, but you can see here right now, we're kind of in that 6.7, 6.8 mark is sort of the average right now. By the end of the year, it's anticipated will be around 6.4. So not a big drop. I don't really, as you can see from this graph, we're not really anticipating much to happen in the first half of the year. Most everything will take place in the back half of the year. Because it's just going to take time. Anytime you have a new administration come in, it takes time for whatever policies or, whatever things will be put in place for the economy and the markets and companies to just get a feel for how that's going to affect things. So again, I don't think too much excitement in the first half of the year. The good news is for buyers it's like anything. Interest rates don't buy houses. Jobs buy houses. We have a very strong housing market in the whole West Coast. I mean, the Seattle market is a strong job market. The whole West Coast is a strong market. I mean, Arizona, California, strong jobs markets. People make good money in these areas. That's what buys houses. And as far as rates go, I don't really see rates driving buyers. They're used to it. They've gotten used to the higher level rates. And overall, historically, if you go back 50 years, we're not at high levels. This is really the average, believe it or not, that rates have been. And people are used to it. So I don't really see it making a big difference. I think that the people that are going to buy are buying. What I'm hoping is we can get first-time home buyers into the market and put a focus in on condos, because there is some big opportunities, I feel like, with condos.
Yep.
versus if people are open to buying condos versus townhomes, single family homes.
Yeah.
Condos are where the opportunities are this year, in my opinion. So this might be the year of the condo.
Yeah, I think that that is the general buzz, even in all of our different forum groups and everything. We're all just saying it is the year of the condo. I mean, it's basically our prices have dropped, specifically downtown, right? That have dropped so much, and there's so much. I guess the momentum of downtown has completely shifted. The press, it's amazing. I think a lot of even like real estate agents, their opinions have changed of downtown. Like during the holidays, they were able to come down and enjoy it, see the restaurants, see what the city was doing. And pretty much all of them came back with like, wow, it's crazy to see how much downtown has changed. And that's the narrative that we've kind of been pushing for the past year. But the people that don't visit downtown a lot, it's nice now to have those voices out there kind of shedding the light, to the other people on the other side of the pond. Um,
Yes.
yeah, just saying, downtown is turning around and our values have come down so much that, they kind of look like deals at this point. They're such values. And so for those, you also have the buzzwords, Amazon coming back to work. You have the other motivations of, and I think we touched on it earlier, empty nesters or downsizers. I mean,
Yes.
at basically every open house I've had this last month, that was the major group that was coming downtown looking. So they wanted something that basically they're downsizing. Their kids are going to college and they're planning ahead and they're planning to put their homes on the market this spring and summer. So I think again, if you're, the first time buyer specifically, if you're out there looking to purchase, condos are just a great way to get into the market, get your location established where you want to be, downtown or in the various neighborhoods. Think about how close in proximity you are to the office, to your workplace, right? And then future, looking to the 5 to 8 year is when you can make that life decision of moving elsewhere. But condos are just such a good way to enter and create your portfolio.
Oh, absolutely. And it always was the way that people got into housing. It
Mhm.
always was. And that was kind of like what people used as their stepping stone and to gain the equity, get into the housing market, because we know statistically that if somebody can buy a home in their 20s versus buying a home in their 30s, the average age right now of the first time home buyer is 38. That's up about 5 years from what it was 7 or 8 years ago.
Yeah.
So that keeps pushing up. If we can get that back into the 20s, statistically, people gain a lot more wealth if they can buy in their 20s versus their 30s or 40s. What was interesting is with the Amazon push to get people back into the office 5 days a week, and other companies are likely to follow that. I had never thought about this until I was talking with a Gen Zer that just graduated from University of Washington. And I asked him, what's your feel about going into the office versus remote? He said, my generation wants to go into work
Yep.
because we've not had that experience. I
Hmm.
mean, boomers and Gen Xers, we were in the office and now we kind of, yeah, we're on the mid part of our career. And so, we've had that. We like the remote.
Yeah,
But
the
the
other thing.
Gen Zers, they're dying to go into the office. They want to dress up. They want to go to lunch with their colleagues. They want to collaborate with their colleagues and they want to learn. And there's no way, there's no replacement for doing that other than the office.
Yep.
You're in the office with your colleagues, you're learning. So I had not thought about it that way until I was talking with him, but I said, you're right. He said, I think you're going to see a lot more companies as they're hiring more Gen Zers,
Hmm.
go back to that in-office jobs, because he said, my generation really does want to be in the office, which that's going to really help the downtown condo markets. And like you said, I've seen restaurants popping up. I was down at Pacific Place and couldn't even find a parking space on the first 3 levels, which was really new
Yeah.
to me. And so I thought, okay, people are coming downtown, and trying to get a reservation at a restaurant is a little bit more challenging. So that's a good thing. And but right now there are definitely deals on condos for sure with some great buildings.
Yeah, and especially the new construction stuff. You have Greystone, you have Spire actually now just announced they're at 85%, which is crazy, but they
Wow, that's
had some
great.
great incentive programs and some great momentum over the last few months.
Yeah.
Greystone, I think, is a property that also offers those incentives, and it's more of that First Hill location, but it's so crazy. I actually scootered from my building to Greystone for an appointment, and it was
You
5 minutes on a city scooter.
Yeah,
So
that's
like it's yeah,
amazing.
so it's like
Yeah.
so close and walkable to downtown. And so it's one that I think buyers should not overlook. And they have floor plans for great for first time buyers. They have larger floor plans too. It's all a gamut of selection. So and all the amenities too are gorgeous.
Yeah.
And then of course you got First Light too with their product there, which it's just depends on what location you want to be. But yeah, I think right now for specifically new home buyers, the new stuff also um, is a pretty good deal.
Well, and a lot of times they can get in, like you mentioned, the incentives. The
Mhm.
incentives, especially if it's in the form of a credit, can really help these buyers, help them cover closing costs
Mhm.
or do temporary buy down programs, which are big right now. I mean, the 2-1 buy down program has been a really great program for home buyers, really for the last couple of years. And just to kind of explain for our viewers what that is it's a 30-year fixed loan, but for the first 2 years, it lets a buyer make the payment on an interest rate that's 2% below the market the first year and 1% below the market the second year,
Yeah.
which, depending on your loan amount, can have significant monthly cash flow savings. And the seller's credit subsidizes that monthly payment for the first 2 years. So it helps that buyer get in maybe at a price point that they're targeting, and it helps them with that monthly payment and kind of bridge that gap between now and when we think there's going to be a good opportunity to be able to refinance. And
Mhm.
it's a great use of a seller credit because it's the only way you can use a seller credit to actually help you with your monthly payment.
Mhm. Yeah.
So,
And usually, I mean, in the buildings, I've heard it's anywhere from 20,000 on up to 40, I think on the higher end for the credits
yeah,
offered right now. So, um,
yes.
and a lot of them
And
including
yeah.
parking versus whereas they weren't before. So things have changed also in their landscape of their offerings. So,
Well, and those incentives can also be used to prepay homeowners dues.
hmm
So, if they get a big credit, like a $40,000 credit,
yeah,
that can be used if there's money left over after closing costs, they can prepay up to 12 months
yeah,
on HOA dues, which is awesome.
hmm yeah.
Yeah.
Well, great. Do you want to talk? I guess we're talking about condos anyway. So, want to talk about a little, when you deal with more of the older buildings, I think at this point we're kind of seeing the buildings I'm not hearing a lot of rumblings, I guess, of special assessments this year. I think a lot of them all increased their dues, but they didn't have as much of a knee-jerk increase as what they did last year because last year was all the insurance hikes that
Yeah.
happened, and then also catching up from COVID for deferred maintenance items. And so last year seemed to be like the big spike that everyone saw downtown. This year it feels a little bit more moderate, and moderate being probably between like I don't know, 3% on the low end and probably between 8% on the higher end of that. And then anything above 10% is pretty aggressive. But are you seeing just in the condo deals that you've had, are you running in any special assessment, special issues that need to be brought up or things that buyers need to be aware of?
Yeah, I think that a lot of property management companies have kind of got their footing now on the new condo rules. There was some major overhaul of condo rules, as you know, that went into effect in September 2023. And,
Mhm.
and essentially what that is it's the biggest change we've seen in probably, I mean, years since I've been in this business. And it was predicated off of that really tragic Surfside condo in Florida where it was proven it was deferred maintenance that where they had just kicked the can down the road and there were critical repairs that didn't get taken care of. So what those rules now require us as lenders to do is the onus is on us as a lender to do a thorough review of the financials of the condo. It's a whole new condo questionnaire for buyers or listeners that may not be aware. You get this resale certificate, which is great. That gives you like the executive summary of the building. As lenders, though, we have to go deeper. And it's now a industry standard form that's a lot more in depth, and the HOA has to complete it, and they have to tell us about when was the last reserve study done. Reserve studies are supposed to be done every 3 years. Doesn't mean they're always getting done every 3 years, but they're supposed to, and they're helpful to the HOA to do them every 3 years, because here's why. Condos, HOAs are supposed to be taking 10% of their annual dues revenue and putting that, flagging that for into the reserves, but not all do. If you have a reserve study though that supports that you're going to be in good shape, like through us reviewing it, we can deduce it. Okay, you don't put 10% in, but the reserve study shows that you're on track with what your maintenance is. That can help you still be able to get financing on it. But if you don't have that reserve study and you're not putting the 10% into reserves, then it's going to kick you out of some types of loans. Not all, but some. The other issue is inspections, structural inspections. If you've had a structural inspection on a building in the last 3 years, we have to review that as a lender. And it's incumbent upon us, if there's any types of what are considered critical type repairs, where they could be structural, they could be health related, safety related, as a lender, we're required to make sure those have been complete before we can lend on that building under traditional type financing, meaning like Fannie Mae, Freddie Mac. Those are going to be like your best type pricing. There's still other options. There's what we call non-qualified mortgage or portfolio type financing, which just simply means it's non-traditional financing that's more flexible. Typically, that means slightly higher interest rate, more down payment. There's still options. But the point is, as a lender, we really are required now by the agencies, because we carry the liability if we don't do that thorough review, and we have to make sure there's not critical repairs. At first, this threw HOAs and property management companies totally for a loop. And they're like, what are you talking about? But now I feel like they've got their footing and they've gone back to some of those older projects. None of the projects that were like kind of 20 years or less really had any issues. But where you did run into some challenges was like projects that are 20 or 25, 30, 35 years old that haven't had inspections done. That can be a challenge. I think the biggest challenge I've seen in the last 6 months is a lot changed with insurance premiums going up. Over the last 3 years, a lot of HOAs and property management companies hiked their deductibles on the buildings. And they didn't realize that to qualify for traditional financing, you can't have the deductible be more than 5% of the value of the building. So I've run into that a couple times where I've had to tell the borrowers, hey, we did your loan last year and it was fine. But now that your HOA hiked your deductible on insurance, it's considered a non-warrantable condo, which means you don't qualify for traditional financing.
Interesting. Yeah.
So but in both cases where this has happened, we've been able to walk the board through this, and they went back to their insurance provider and revised the insurance to back down to 5%. So the condo became warrantable again. That's, I would say, what I'm seeing though, and that's still reverberating.
Gotcha.
Through the industry.
Yeah. There's just so many different things to consider for sure. But, I think overall the condo market on that side feels healthier than what it was 2 years ago, for sure.
For sure. For sure. Absolutely. Yep.
Yeah.
Absolutely. Definitely.
Do you want to talk about and this is for single family as well as condos, I guess, but like different down payment assistant programs and different loan options that you have?
Yeah, definitely. So there's some great down payment assistance program. A lot of people don't really realize that you can, if you're eligible and you meet the guidelines, can qualify for literally zero down payment. There's kind of the traditional down payment assistance program where it's a 3% of the sales price. Now, there are income limits on it depending on the county in which the property is located. So it's really important any buyer talk with their loan officer. In King County, it's around 150 It's around the 150
Yeah.
mark, but again, talk with the
Great.
loan officer. But there was a new program that came out this year that is an exceptional program, and it's got some definite specifics on being eligible, but I'm going to put up a slide that I created for it because I think it is an important one to highlight. If clients qualify for this program, it is absolutely a game changer program in some communities. It's called the Covenant Homeownership Act program, and I'm certified in this program and have done a few of them, but it can provide up to $150,000 of down payment assistance, up to, so 20% down up to 150,000, whichever is less, plus closing costs. It's a zero interest loan. It still is a lien against the property, so it has to be paid off. If you sell the property, you refinance. But you can look at, here's kind of the highlights. You can go up to an income level of 147,400 in King County. So
Wow.
if you're making 147,400 in King or Snohomish County, you could be eligible for this program, 112 in Paris. It's got to be a first-time home buyer, which is defined as someone who hasn't owned a home in the past 3 years. So you could have owned a home in the past, but as long as you haven't owned it in the last 3 years, you are considered to be a first-time home buyer. This program is targeted at communities that are Black, Hispanic, Native American, Alaska Native, Native Hawaiian, or other Pacific Islander, Korean, or Asian Indian. And the biggest thing is they had to have had family lineage in the state of Washington, like a parent, grandparent, great grandparent that has ties to the state of Washington and lived here before April of 1968, which is when fair housing was enacted.
Got it.
So if a client is eligible under this, it's a fabulous program for them to do. It's a great way to get people into home ownership. And there's a lot of documentation that we can use to verify that family connection. I mean, we can use newspaper articles, we can use residency documentation. There's a lot of different documentation that the Washington State Housing Finance Commission is allowed to accept. So, you know, it's a conversation I would have on an individual basis with clients, just depending on what their scenario is. But this one's a game changer. This program's really been utilized this year, and I think it's going to continue to really be utilized as a down payment assistance program for people. So
That's great.
definitely
What
one.
is this for single household? Is there different rules for double income households?
No, it's, I mean, so total borrowers.
Of total
Income.
borrowers. Okay,
Yeah,
so
household income.
Yeah, there it is.
Yeah.
Okay.
So that's kind of the key, because if you have two people on the loan, it's going to look at both their income.
Yep. Okay.
So if you have one person on the loan, it's going to look at the income. But you can buy a condo with it. You can buy a single family home. You can buy a townhome. You know, it'll cover manufactured homes. It will cover the gamut on different homes to be able to buy.
Awesome.
So it's a fabulous program if clients meet the eligibility for it. If they don't, we have other down payment assistance programs. There's really a lot of them out there. It more or less is, it's never a one size fits all. It's a unique conversation to really determine what's the best fit. This also spans for conventional and FHA. So we could do FHA with it, we can do conventional with it, depending on the eligibility and qualifications of the buyers. So
how long is the process for this? Like how long does it take?
you know, I close them still within 30 days.
Okay.
Definitely we need to do a pre-approval first.
Yeah.
For these types of programs, we're gonna want to get the pre-approval done ASAP, because we need to make sure that you're really qualified, because you cannot be one penny over this income limit. We can't find out you're really at 148 or 147,401. So I urge the pre-approval up front. But yes, this applies to all types of housing, you know, single family condo, manufactured, townhome, all that. So it's great. It's a great opportunity. The other thing we're starting to see that I know I'm making a push to educate people about is the whole idea of you might have heard this, but the boomer generation is considered over the next 20 years, it's going to be the biggest wealth transfer because the boomers have a lot of money that they're holding that over the next 20 years is going to go to their kids that are Gen X and Gen Z. A lot of people haven't met with estate planners and attorneys, and they don't know the laws on this. And I have to admit, I was actually a little bit fuzzy on it until unfortunately my own parents passed away. And now I've really learned the ins and outs of this estate planning. And it's the whole concept of gifting while alive. And if the boomer generation or the parents have the ability and they have the funds, most of the time they're planning to give a large portion of their wealth to their kids. Some people, if they have it right now, there's such a benefit to gifting those funds to the kids now to be able to buy a house. Because again, getting into homeownership in the 20s versus getting into homeownership in the 30s makes a big difference over the lifetime of those kids for what their wealth is going to be. So I'm really trying to go out and educate people that a lot of people are under the impression that you can't gift more than whatever that yearly annual limit is set by the IRS. That's not true. Every one of us can technically gift to the lifetime federal limit, which right now happens to be is $13 million.
Oh, wow.
Over your lifetime, you can gift up to that much of your wealth out to various individuals. So a parent, they can gift $200,000 towards a down payment to their kids at one time and not pay taxes on that money. They just have to file a form through if they're using CPA, their CPA will know how to file it. If they're doing it on their own, it's like a 706 form. They have to file that form. So check with your CPA. I'm not a CPA, not a state attorney. I have to give that disclaimer, but check with your state attorney, check with your CPA, but have the conversation because you can do it. You do have to notify the IRS and they keep a tally, but the donor doesn't pay taxes on it and neither does the gifter and the recipient do not pay taxes on those funds unless you're over that 13 million limit. But the majority of people are not going to be. So the parents can gift that early. And so I'm trying to get that word out there because that can make a massive difference if the parents have the ability to gift that now versus waiting until they pass away. Give it now. And because it makes a big difference for the kids to get into a house.
And I will say, as that kind of catches on and people are using that as their strategy, there will be some sort of change in the whole IRS system and how that gifting. I mean,
there might be,
probably in the works at some point down the road. So it's better to get on it now and
get on it now.
Yeah.
Yeah, you're right. They probably will cause a change. Yeah, but definitely have the estate conversation. I mean, that's just a good rule of thumb. It's something I advise all my clients to do when we're talking about buying a house, because when you own an asset, typically that's the largest asset most people have. You definitely need to have a CPA to advise you, and you need to have an estate attorney to be able to have your estate stuff in order, especially with an asset that big.
Definitely. Yeah. I know between both of you and I, we could probably recommend if anyone out there needs a contact or two, we definitely could do that. So
for sure. Definitely.
Great. Yeah. Well, I think what else do you have on your agenda? I'm like looking at all of our little topics here and we kind of did a good job rounding things out.
Yeah. I think that the one I definitely want to touch on is the whole cost of waiting. There's that theme out there, people, and it's human nature. Like when you don't know what's going on, you just kind of want to wait and see. And look, people have to follow their comfort level. Like I never believe in pushing people. I mean, people need to do what's right for them always and check with their trusted advisors, whoever those people are, if it's family members, a financial advisor, CPA, they should always be talking with their trusted advisors. However, here's the math on waiting. Okay, so this is what I call a cost of waiting analysis. It's really basic. So, and of course, we can go ahead with individual buyers and we can model this out with more specifics, but here is a scenario that I did for the purposes of today. I took a $600,000 property. So this assumes today you could buy a house for $600,000. Over the next 6 months, it is anticipated appreciation is going to be about 2.3% in the 98121 zip code. Over the next year, it's anticipated that properties will appreciate at 4.73% over the next year. Okay. So if you were to put 10% down, for example, that's a loan amount of 540. This shows you that if you were to wait and not buy for 6 months, you would have lost out on $14,176 in appreciation. If you wait a year, you would have lost out on $28,351 in appreciation. If you carry that down, let's say, but I want to wait till interest rates come down. Okay. So right now, let's say they're hovering around 7%. Let's say in 6 months, they're 6.5%. Okay. So the monthly payment, by the time you adjust what you would have to pay for that property, your payment is about $100 less in 6 months. That's the only difference. That's that half a point rate combined with the fact you'd have to pay about $14,000 more for that same property. You've only saved yourself about $100. Again, if you wait a year, that difference works out to be about $200. But here's what you have to factor in overall. You go back up to, you would have lost out on a net of $22,275,000 because you lose out on the appreciation gain. Yes, your cumulative difference in payment would save you about $2,000 over the year. And the cost to refinance to get down to the 6% rate in a year, factoring that in, you still would come out ahead by $22,000 by buying today versus waiting a year.
Yep.
So that's a good one that I think is helpful. And when I show that to buyers, it generally is like, wow, I didn't think about it that way. I didn't think about the appreciation I might be leaving on the table. And we both know there's not a lot more inventory coming on the market anytime soon. And whenever interest rates drop, it's going to drive more demand into the market. So those buyers that are sitting on the edge, they're sitting on the sidelines, are going to jump into the market when rates come down. For every 1% drop in rate, 5 million more people nationwide now qualify. And that's not, unfortunately, going to be even across the nation where those buyers are going to come from. They're going to typically probably disproportionately be in areas that are more populated. So Seattle, the West Coast, areas where people really want to live.
Yep.
So this is a good one to think about, for buyers to really think about.
Does that also take into account the equity that you're paying? Okay. Yeah. So, I mean, it's just like you getting in early allows you to build your equity within the property, and it just is other things for write-offs and all the other things.
Yeah. Well, and then, the benefits, like that's something else we could pop up here real quick. Just the benefits of home ownership. Sometimes I think, we think people know, but people don't know this. This is something too I go over on my buyer consultations. It's important to highlight that on average in the past, every year it's been an average of around 5 to 6% average home equity growth. That for a lot of people, when people get to their retirement years, a lot of people really rely on the equity that they built in their house as part of their retirement. They may use that equity as a stream when they sell the property, as a stream of income. They might borrow against it, or they may downsize, get that money in cash invested, and then that's what they live off of. So, that's that home equity, it's like a silent savings account as people are growing their wealth. 30-year fixed payment is predictable. The payment's not going to change for 30 years. Now, taxes and insurance will go up over time. We know that, but at least if you can make your payment predictable, that's a big thing. Rent is not predictable. And rent's going up too. Rent has been going up. Tax advantages. There are write-offs. Again, check with your CPA, of course, because everybody's tax situation is different. But there's tax advantages, mortgage interest, property taxes, PMI, capital gains exclusions. Those are all tax advantaged. And that's another reason why I recommend people, especially when they become homeowners, they work with a CPA, because you want to make sure you're really taking advantage of all the possible tax advantages that are out there. Yep. It's 40 times more wealth that's built for homeowners than renters on average. 70% of millionaires built their wealth through homeownership. So this just can't be overemphasized, just the reasons to buy a home. So important. So,
yep.
Yeah.
And going back to your point of, rental rates on the rise, I mean, rents have been pretty stable or consistent. They went down a little bit, they kind of, bop up and down. We are seeing now reported numbers that rent in the downtown area especially is kind of ticking up a little bit. I want to say it was 5% is what I heard. And, that's subject to the specific property and location downtown and all that sort of thing. But that is where we typically see, and also downtown, I know it wasn't something that I mentioned earlier, but the health of our condo values is really important and relies on the rental rates, because the two markets kind of work together, right? So when it's more economical to rent than it is to purchase in the last, few years, it's just between the interest rates and the rising costs of, the HOA dues and all that sort of thing. Condos kind of tapped out a little bit, and that's why they kind of came down in their price, because you had a lot of this new construction, apartment buildings that came in, offering a lot of concessions to get the buildings filled up, like 1 to 2, 3 months rent free, all that sort of thing. So a first-time home buyer coming in, someone who's new, maybe had their first-time job, thinks really, okay, well, this makes more sense to rent right now. Well, as the rents start to rise, then you kind of have these condos now that are at the value and the stability mark where that actually becomes, it's more fruitful actually to purchase, to invest in your future. And so that's, again, the year of the condo. This is kind of the baseline, is where we see that kind of taking off. And you don't really want to be in the market like we were in 2000, probably between 14 and 16. I know the high of condos was October, 17 or something. But during that, 14, 15, 16 timeframe, we saw a lot of cash offers, a lot of cash being downtown. I mean, one offer, condo, it was a 1-bedroom, nothing to write home about, had 14 offers on it.
Yes.
That is just, I mean, so we don't want to get to that point before you kind of decide to jump in. Really, it's, where we're all saying that these are the signs that we're seeing. This is the time to actually invest and get in. So really good time. Can't stress it enough for what's happening downtown, just condos in general, and getting into home ownership is just very, very, very important.
Yeah, for sure. And the thing about it is if you're looking at it on par, I mean, the cost of renting versus what the cost is, what your monthly payment is as an owner, it's likely not going to be even unless you're putting a lot down. I mean, there is going to be a premium for home ownership, but over time, if you're a potential buyer that can afford that difference in the payment, of course, nobody should ever put themselves in a financial position where they're not comfortable with that monthly payment. But as a renter, if you're just simply going, well, gosh, I'm just going to keep renting because the cost to buy, my monthly payment's going to be more. It's probably always going to be more at these price levels, but the differences over time outweigh, because you have to factor in the appreciation and the fact that rent will continue to rise over time. Whereas when you're buying, you can fix your payment. You have more control over your payment. Plus, again, the whole appreciation, the tax advantages, you now are in control of where you live. You're not going to at the whim of a landlord that's going to say, well, I want to sell, you got to move out now. So,
Look at it like your little piggy bank too, right? Your principal payment, piggy bank.
Yeah.
Right?
Yeah.
You're paying down your loan every single month, and the longer you owe it, your greater your payment goes down every month.
You
So
either are buying your own house when you're paying the mortgage.
you're
If
buying,
you're renting, you're just buying the landlord's property.
yeah.
What would you rather do?
Yeah, definitely. And then for those people who are like, well, I don't know where I'm going to be in 2 to 3 years. Well, that's
Mhm.
actually fine too. Just get in a building that you're able to look forward and actually know the rental value of the property that you're purchasing so that you could plan for the future and think, okay, well, if I can't sell it or I'm not in a market to sell it or, I just don't want to at that time, rent it for a couple years and then just kind of at that point make the decision after that, that life occurrence happens.
Yep.
But give that flexibility to yourself and start forward thinking like that.
Totally.
Yeah.
Agreed.
So,
Absolutely agree. Yeah.
sweet. Well, I always love
Oh,
you. I feel so jazzed going into the
there's always opportunities. There's always good stuff. But yeah, I always love chatting with you. And it'll be fun is if towards the end of the year we do
Oh,
another
yeah.
one of these and see where we ended up, like how the year progressed and how off or on we were on what we were thinking was going to
Yeah,
happen. Like every year has a theme, I feel like. And I think we're still seeing what this one looks like, but
for
this one
sure.
seems a little bit smoother than other years. So we'll see.
Yeah.
Yeah.
Good. That's a great idea. We'll definitely do that.
Yeah.
Post this video again on YouTube for anyone to kind of come back to.
Great.
And then also put all your contact information out there too, so people can reach
Yeah.
out to you or me, and we could be a resource for anyone out there who's looking to purchase this year, and really just give you that level of service that you need and support
Yeah.
kind of getting into the market.
Thank you. Yes, and I will also I'll post it on my YouTube channel too, and I'll tag you back, tag you back on all my
Yeah,
social posts
if you
from it
don't
too. So
follow Carese, she has some great videos and just your Instagram presence is awesome. So
thank
definitely
you.
follow her. And what's your handle? Just Facebook.
It is Carese. It's at Carese Busby. Yeah.
Yeah, sweet, good.
Wow.
All right, well, thank you everyone for joining, and Carese, thank you so much.
Yes. Thank you.